For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Well, yes, of course. Thank you. Welcome back. It is the podcast. Johnny Dean, Professor Rick Plum. Hello, Professor Plum.
Good morning. Good evening. Good evening.
Yes.
Good afternoon.
Well, we have to cover that every single time. You know, we got to cover every and middle of the night kind of stuff. Nice to see you. You are the certified financial planner professional. Are you not?
I am.
There you go. You
I
see?
admit to it. I'll cop to it.
That's right. We'll cop to that. I'm your podcast host, Johnny Dean, and we're back here with another episode of Managing Your Financial Future. I know we've had some people ask us questions from time to time about certain things that we say, we say, yeah, we'd like to address them on the podcast. Here's the issue with that. We, I think I mentioned this last week, we record these sometimes 8-9 weeks in advance. So if you hear something on the podcast and you say, hey, I'd really like to have you follow up on that, it may take a while. So we apologize for that, but that's kind of that's the nature of this particular podcast. The recording has to go through a bunch of compliance and all this other stuff, which is why you hear all those great disclaimers at the end of the show. So we have to do this at least several weeks in advance before this airs. So if you have asked us questions about certain podcasts, about certain topics, about certain episodes, rest assured, we're still reading them and we're going to address them. Now, Professor Plum, today I'm going to kind of revisit a topic that we covered. I think it was way back in January, sometime at the beginning of this year, because we have gotten some questions, but we've had some interest in this over the last several months, just from people who are saying, I need to ask you about this. And it has it's the whole idea of risk versus volatility. And I'd like to cover that again, just to sort of get a little bit deeper into that topic and why it's important to understand the distinction between those two. Now,
yeah, it's very important because the most of the presentations that are out there, the different things that are being written, they equate, risk is the unknown expectation that the stock market goes down. No, we know the stock market's going to go down. It's not unexpected. We just don't know the exact timing. Risk is you having to sell your stock market investments when the market is down. Volatility is there. It's going to happen. But they equate volatility and risk as the same thing.
Well, and I think they do that because they're not using the correct strategy. Now, what I did was I went through and I tried to get different points of view on risk versus volatility. And what I came up with just online is the definition of volatility. And tell me if you agree with this. You probably will. This is just one of the sources that said, at its simplest, volatility is a way of describing the degree by which share price values fluctuate. In volatile periods, share prices swing sharply up and down, while in less volatile periods, their performance is smoother and more predictable. Would you agree with that?
Up and down.
Yeah, would you agree with that definition of volatility?
Sure, that sounds reasonable.
Yeah, I think that is true. So here's where I have a little bit of a problem, and I think you would too, which is why I wanted to discuss this topic today. They say risk, on the other hand, is the chance of investments declining in value. Now, I personally think that's an incomplete definition, which means that I am disagreeing with that statement. Professor Plum, just agree or disagree? What do you say?
That's the definition of negative volatility. Stocks go up, positive side. Stocks go down, negative side. That's volatility.
Yeah.
Risk is something else. Risk is me losing money.
Yes. Well, yes.
Me losing real money.
I would say
when a stock goes up in value, I technically haven't made any money unless I sell it. It's a paper gain. I could lose it before I actually sell it. So therefore, I haven't actually made the money until I sell it. On the downside, I haven't actually lost it until I sell it either.
Well,
And
so yes. Let me tell you my definition and tell me if you agree with this. Risk is the chance of investments declining in value at the precise moment that you need to spend the money. Would you define that as risk?
that's a partial definition because unfortunately a lot of people face risk not only because they have to sell to raise the capital to spend it at a particular moment, but because they're afraid and they sell even if they don't need the money.
Well, they're creating their
to
own
me,
risk. Yeah.
Risk is the fact that you are selling at a downside. Risk is, for whatever reason, selling and realizing, creating, changing it from a paper gain or loss to a real gain or loss, changing my hypothetical loss to a real loss. That's risk. When I, for whatever reason, change my investment philosophy and I lose money, real money, no longer hypothetical, not a paper loss. It's a real loss now. And I'm doing it because either I have to, like you mentioned, because I've got to pay my mortgage or whatever the case may be, put the kids through school, whatever, or I'm just afraid that I'm going to lose money. And so my fear of actually losing money triggers me into really losing money by selling.
Well, okay. So risk is a condition, okay? Risk is a condition that exists. It may or may not harm me, but there is the chance that it will. So here's a question that we get a lot, and I'm sure you've gotten.
That's volatility.
Well, volatility is it going up and down in value? That's right. The swinging back and forth,
which we have absolutely no control over.
No, we have no control over that, but that's not risk. Now, let me ask you this. What if somebody came to you and they said, Professor Plum, do you believe the stock market is risky? What would your answer be?
Over what time frame?
There you go. Okay.
Over a 1 year time frame? Oh, yeah. It can be very risky.
Right.
Depending on how much historical terms you want to look at. If you look at the market since like 1871, the chance of losing, or the worst 1 year period of time in the U.S. stock market, the S&P, minus 60, almost minus 68% in a 1 year time period. Yeah, that's volatility. And if I sell when it's down that far because I'm afraid, and you know what? Losing 2/3 of my value in a year, that would make almost anybody afraid. That's the risk that you sell when it's down. But on the other hand, the longer that you have, if you don't sell it at that point, and you allow yourself time for those markets to recover, you get out to 5 years, 10 years, 15 years, you have a much better chance of actually making money. You get out to a 15-year hold, even the worst 15-year rolling period of time since 1871 was a basically break even.
That's the worst 15-year period of time.
And that included the Great Depression. That included times in the 1800s when the rules were very different and it was kind of Wild West type. So if we don't want to look back at those days, what about the last 30 years? The worst 1 year period of time is minus 44%. That's still pretty significant. That would again also make people very afraid. The worst 15-year period of time, if you could buy and hold that market investment. I'm not talking about an individual stock. I'm talking about a diversified stock portfolio like the S&P. The worst case scenario, a little over 4% positive. Okay, that's not the greatest rate of return. No, I'm not talking about the greatest. I'm talking about the worst. The worst 15-year rolling time period over the last 30 years was a plus 4%. That was most likely, I don't have the actual numbers, 2000 to 2015.
Well, we had that 10-year period of time where it pretty much did nothing.
It went nowhere.
Between 2000 and the end of 2009 or whatever that period was. But it was about 10 years where nothing happened. Okay.
So the idea of, is it risky? Is the market a risky place? On a 1 year time horizon? Yeah, it's got some significant risk. If you have to pull out or you're going to pull out after a year, you have a very high probability. No, you have a decent probability you're going to lose some money. That's risk. That's a problem if you have to pull out. Now, if you can leave it alone for 10, 15 years, your ability to gain and earn goes up quite a bit.
Well, Go ahead.
Get into the 10 and 15-year period. Just over the last 30 years, you had the chance of even the worst 10-year was minus 2.5%, but the best 10-year period was 16.5%. Are you willing to let it ride for that 10-year period of time, given that downside versus that upside? The further out you go, the better the worst case scenario becomes for you. To a point where at some point, if you can hold on long enough, you can make money. The problem is, can you hold on? And the retirees saying, well, I don't have 15 years. You do with some of your money. You do with the money that you're 65. You do with the money you're not going to spend until you're 80.
Well,
You don't
exactly.
have to have all of the money the first day.
Exactly. So the risk, Professor Plum, the risk comes from the volatility, but volatility is not risk. And I think this is what your point was when you mentioned that what I said was volatility. You see, volatility is the up and down, right?
Right.
Now, if I need to
There's
jump
nothing we
in,
can do to stop that.
right, the volatility can create risk if I'm going to jump into it and I need the money at exactly that time. But if
Go ahead.
if you can,
It's just volatility and risk. They are coordinated with each other, but one is not the other. One is basically, I see risk as my reaction
yes,
to the volatility, whether it's a forced reaction or an emotional reaction.
yeah,
My risk is that I sell at the wrong time for whatever reason, that I sell and I turn a hypothetical loss into a real loss.
yes. Well, the risk is that you need the money for whatever reason, either because you're selling because you're scared, or you're selling because you actually need to spend the money. But the risk is that you say, I'm putting the money away and I'm going to put it away for just a year. I'm probably going to get scared as soon as it goes down and I'm going to sell. Well, that is a risky situation right there. If you actually
and as
do
an
it.
advisor, if somebody says, if it goes down, I'm going to sell, then I have to worry about and maybe not put them in a position where because I can't control the volatility of the market. And if they've told me, if it goes down, I'm selling. Well, they've already told me they can't handle the risk. Therefore, we can't introduce risk into their investment thesis. We have to be careful with the way they're investing. And by that very nature, they have to be willing to accept a less than stock market return. They can't say, well, I want to get those 10+% rates of return, but I want no risk. Well, those don't go together.
No, that's not going to happen. Yeah.
But I do know people who have said, I do not want to. I've got the proverbial $1 million portfolio. I don't even need the $40,000 from it. I need less than that. I'm just so they could, by definition, be much more aggressive because they don't need the money. But they also say, I don't want to see a negative number on my statement. Any statement, not just an ongoing annual statement. I don't want to see a negative number on a monthly statement. Okay, well, if you are dictating those parameters, then you cannot invest in something that has volatility, because you've told me that you're going to sell if it goes down.
Yeah.
We can't deal with we can't deal with that.
If you tell somebody, look, over the course of 15 years, the risk of investing in the stock market, that is the risk that you're going to lose money, has historically been lower. In fact, as you just said, over a 15-year period of time, just historically speaking, the worst was, what did you say, 4%
Over
gain?
the last 30 years, it's almost a 4.5% rate of return. That's the worst case.
Right, that's the worst case. Now, that's not saying that going forward that's going to always be the case. But if you go back to, as you said, to 1871, I mean, we see a pattern that
break even at 15 years over the last 154 years on 15-year rolling time.
Yeah, we don't need to go quite back that far, but that can show you the power of the numbers. So while you can't make a definite prediction about it, you can say with some certainty that a 15-year period of time in the stock market is going to, historically speaking anyway, give you a positive rate of return.
It has definitely done that. It has been working that way.
Yeah.
Like you said, the history is only so much of an indicator. We don't know what the future holds. But we know that if you're doing it for a 1-year time horizon, we know that that has a significant amount of volatility. And if your reaction is one that makes you sell, it has a significant amount of risk.
Yeah. So you have volatility, though. If you have a 15-year period of time, that volatility is still going to be happening on a short-term basis, daily, weekly. I mean, that's not going away. So somebody might ask you, as we've gotten questions from people who have been listening to this and saying, well, gee, I mean, over 15 years of time, there's volatility in the short run all the way through. Sure, so how does a 15-year period of time mitigate that risk? I mean, I'm going to need this money 15 years from now, and we're going to have volatility in the short run all the way through those 15 years. So, Professor Plum, what do you tell somebody who says, but I'm going to need that 15 years from now? So, I mean, isn't that still risk?
10 years.
What's that?
Call me in 10 years.
Oh, call me in 10 years. Yeah.
The whole idea is once you've identified that you have that time horizon for at least that amount of money. Yeah. This is meant for a retiree. It's not for all of the money, because we have to have some money to spend while we're waiting for that 15-year period of time to go by. But it's also this is generally not a set it and forget it. It's a matter of, we know that we've protected against most, everything that's happened in history. We don't know what's in the future. But like I said, okay, the last 30 years, the worst was 4.5 or 4.37%.
Mm-hmm.
Well, the best was 16. No, it wasn't. It was 15.84%, just shy of 16%.
Yeah.
So, I mean, you could do much better than the historical averages of 9 or 10. So the idea is to monitor where you are on those rolling periods. Over a 5-year rolling period, the best 5-year rolling period was plus 22%, 23%.
Over the last what?
Over the last 30 years.
Okay. And what and okay. Now, so what was
so what you do is, if you're way above, and this goes against human nature, if you're way above what the expected return of 8, 7, 8, 9%, whatever the case may be, you've put on as your barometer, and you're at 22% over the last 5 years. You started at 100,000, you were up 22% for the last 5 years. Each year, you're way ahead of where you thought you were going to be. Let's reset that 15-year time horizon, take some money off the table, and put it into something safer. Therefore, if it does then turn into a bad next 10 years, you got money on the side for the next 5. So you got 15-year time horizon again.
Well, this is true, and it's probably it could be a necessary thing to do. Now, here's the other thing. We hear a lot about people saying, well, gee, the older you get, the less time you have. So the less exposure to stocks you should have. So in other words, if you're 65, maybe you should only have, 40% of your money in stocks, and we're going to keep the rest safe. But as you get older, you obviously have less time. So we're going to mitigate that risk by taking money out of the stock market. Now, Professor Plum, I mean, first of all, what are your thoughts on that? As if I haven't asked you that in previous episodes.
Well, there's two ways to look at it. One is, how does it feel? Because if I've got a 90-year-old and they are just uncomfortable with the volatility of the market, this is a volatility issue turning into a risk issue because of emotions. They don't need the money. They're not going to, their spending habits are not such that they need a 15-20% withdrawal rate from their portfolio. But it's a matter of how they feel. Does it affect them and how they sleep at night? But from a purely financial standpoint, yes, a 65-year-old probably should be, if it's doing a 4%, 5% distribution and getting ready to retire, they should be about 35% stocks, 40% stocks. But as you get older, and the whole idea there is because we need to provide for potentially 30 plus years of retirement distributions. But when I get into my 85s and 90s, I don't necessarily need to be able to provide for 35 years of distributions anymore. Most people aren't going to make it to 115, 120 years old. And so you can afford to have, from a purely financial standpoint, more stock in your portfolio as a 90-year-old than you can as a 35-year-old because of the need of what you're trying to accomplish. So if I'm 90 years old and I'm taking a 5% distribution from my portfolio, I can still be 50, 60% in stocks because, unfortunately, it's going to sound horrible, how many more years do we have to provide this cash flow?
Well, exactly. And let me tell you something when we talk about things like the bucket strategy, which will spend the safer money first, the non-volatile money first, and you leave we'll call it the stock market money, the volatile money alone for 15 years, let's call it, right, in bucket 3 where we don't have to touch it for that long.
To mitigate the risk of selling when it's down.
Right. But that's true. And that's where I'm leading with this. Now, but of course, Professor Plum, by nature, The bucket strategy, when you're spending down buckets 1 and buckets 2, you are, in fact, just by default, are you not, increasing the amount of money, the percentage of stocks that are in your portfolio. In other words, after 10 years, you spent maybe 2/3 of bucket 1 and bucket 2, and I'm not talking about rebalancing or anything. I'm leaving that out for a moment.
If you don't do any value averaging,
yeah,
by its definition, you're spending the safe money down. So, and you're leaving the more volatile money, the growth money, hopefully to grow. So if you had 400,000 in growth, it may become 600, 700,000 by the time bucket number 1, the 200,000 in bucket number 1 goes away. So now you're significantly higher in percentage in the growth volatile areas than you were when you started. You were 35% in stocks, and now you're 50%, 60% in stocks.
So now you're 80 years old, Professor Plum, and let's say you don't do any value averaging, and you've got another year or so left, and you are almost purely stock because your bucket 3, buckets 1 and 2 have been spent. I've heard people.
So I am a big proponent of value averaging, though.
Yes. All right.
And whether I'm value averaging at year 14, 13, 10, 5, whatever the case may be, depends on what the market has given us. That volatility that we cannot control. Have we had a positive sequence of returns, throwing back to last week, or have we had a negative sequence of returns, and do I need more time for it to recover? But I want to see where we are compared to where we expected to be, and I want to do value averaging when it's opportunistic to do so that I don't necessarily get down to, because now if I'm going on that 15-year time horizon and I'm 14 years into it, I've spent all of bucket number 1, I've spent almost all of bucket number 2. Now I've got a 1-year time horizon. Now I'm introducing, I need some money in a year.
And it's all in stocks.
And now I'm introducing risk to the situation.
Yes.
So I want to, try to alleviate that risk by doing appropriate value averaging, which is not an automatic. It is not something that you just set the computer to do every year. It's not automatic rebalancing. It's opportunistic. And I'm not saying that we're going to do it at the top of the market because we never know when the top of the market is. I'm saying you do it when you can, when you have the excess return in your favor to be able to do the value averaging that is appropriate for what's going on, so that you never put yourself in a position that you start introducing risk that you don't need.
Yeah, certainly that if you haven't done value averaging in your 13, 14 years into your bucket strategy, you are introducing perhaps some element of risk, although I would have hoped that over that 14-year period of time you've had some growth.
Yeah, hopefully the portfolio has grown back to where it was, or at least what you started with. But on the other side, it also depends on what are you spending now. So you started at 65 with your proverbial 4% distribution. Now you're 80 years old. Are you still spending 4% or more of the portfolio? Because a lot of people, when they get into the late 70s, 80s, they slow down their spending. Not on purpose. It just happens because they don't go out as often. They don't go eat. They don't drive as much. They don't do as much. They don't shop as much. This isn't everybody, because I know my grandfather, he was busier when he was 80 probably than when he was 65, but that guy was all over the place. But for a lot of people, the spending tends to slow down a little bit. So what is your distribution rate at 80? So your portfolio is back to $1.2 million, $1.3 million, but maybe you're only spending $30,000. So you got like a 2.5% distribution rate. Redo the plan to reflect what's happening in your life as you go along.
Yeah. The idea,
you're value averaging and you're reshuffling to reflect life.
Now, for those who don't know, have not heard this, the topic of value averaging, which is part of a bucket strategy, Professor, essentially what you're doing is you're taking a look at your percentages. You're taking a look at perhaps the gain or loss that you may have during a particular time
period,
year, 2 years, whatever it happens to be. And this is the idea of either skimming some off the top of bucket 3 we're talking about, skimming some off the top if you're higher than you expected to be at this time, or if you're lower than you expected to be, perhaps adding to some of that bucket 3.
That was a little harder to get people to do, but the taking some cream off the top is something that people understand and will do. The whole idea of the buckets concept is to create cash flow from areas that are not affected by the market, and so that we can leave the assets that are affected by the market alone for a long enough period of time to mitigate that risk we talked about earlier. but it doesn't necessarily mean that. So we're doing this to protect against downturns. We're doing it to protect against, I retired in 1999 and then I watched the stock market plummet the next year. I retired in 2007 and I watched the stock market plummet the next year. I retired in 2021 and then the stock and bond market kind of went down big time in 2022. Right. And so I'm trying, we do buckets to protect against those unknown time horizons. But that doesn't mean you're going to be Mr. Murphy from Mr. Murphy's Law, and that you are going to retire at the very worst time. And at some point in your horizon, you have better than expected returns. Volatility goes both ways. We're talking about risk as, that's being created by negative volatility. But there's also positive volatility, movements higher than expected, movements above the average. And that way, if we can monitor that going forward, and we say, you know what, you're well ahead. Now, value averaging doesn't happen at a specific amount. So let's see, I expect a 9% rate of return out of my bucket number 3. I put in $100,000, so I should have 109 at the end of the year. I'm at 110. I'm probably not all that excited about value averaging $1,000 out of this. But by the same token, if after 2 or 3 years, like if after, we went up 21% in 2020, we went up 29% in 2022. My 100,000 turned into 140 when I thought it would be 120-ish. There's $20,000 or more of money that I can pull off the table and value average.
In other words, sell that off at a higher value than it was, and put it into something that's not volatile.
Put it into something safe. Now, it just happened that 2022 was not the best time, so that gave me more time frame. I've stretched out my time horizon again because now I have more money and safety that I can postpone having to sell again for a while, or I can use that dry powder to buy in when the markets are lower. Who knows when the bottom is? That's why it's harder to get people to do that.
Yeah.
But if you're always looking to sell at the high side and then maybe buy at the low side, that's the way to make money. But that's not what most people do. They do it the exact opposite. We talked about that last week. The flow is going in, the flow is going out. People go in at the high side, come out at the low side. How do we break that trend? We look at it and we have a plan of action that tells us how we're going to react and when to react. Now, so if the market's up 50% in the first year, I'm probably value averaging the first year. If it's up 1% or 1% more than expected in the first year, I'm probably not value averaging. The longer it goes, the tighter my tolerances go. If after 7 years I'm up 14% instead of 9%, I'm value averaging at that point. I'm taking that excess, I'm reshuffling the deck. And I'm building a new time horizon. I'm building a new 15-year period of time because I've just gone through a really nice 5-6 year period of time. Who knows what the next 5, 6, 7 year period of time is going to be?
So would you say
on where we are?
Would you say you're using the volatility to your potential advantage in this case?
I am trying to be as opportunistic with something that I cannot control as possible.
Yes.
I'm protecting against it by doing the buckets, but I'm looking for a reason to make money.
Well, I heard somebody mention that the volatility is like the weather. I mean, it's going to happen. You're going to have thunderstorms, you're going to have rain, you're going to have sunshine, you're going to have good days, you're going to have bad days, and that kind of stuff. But if you're looking to get something done outdoors and you see that there is a better than expected weather report, in other words, you expected rain or snow, but you got a beautiful sunny day and you got to get some yard work done, take that, what it's giving you, and use it to your advantage. Go out and get that gardening done when the sun is shining. That's what they would the old make hay when the sun is shining.
If you have an unexpectedly glorious day, take advantage of it.
Right. Yes.
If you have an unexpected glorious return in the market, take advantage of it. Don't just let it sit there and turn into mud tomorrow when the rain comes back.
Well, exactly. We like to use analogies, folks, on this show. Don't try this at home.
Make them up.
We are professionals, all right? But I think it helps. I think it helps to see for people to see that. And when we talk about this particular episode where we're saying risk is not volatility, I mean, volatility can create risk if the person is not, you are actually creating your own risk if you are reacting to the volatility in a bad way.
Necessary to sell or emotionally needy to sell.
Yes.
You're creating your own risk.
Now, as you said, for people who have the emotional need, they say, I don't care. I do not want to see a negative number. And there's nothing wrong with that. Not a thing wrong with that. But what we'll do...
Unless you put yourself in a position that you're going to see a negative number.
Yes, exactly. I mean...
We see people that do that. They say, I don't want to see any negative numbers, but buy me the ETF that does this. Well, it's a stock ETF. There will be bad days. It's inevitable. It's going to happen.
Of course.
But they say, well, I want that return. Then you have to accept the short-term volatility, which will show a negative number from time to time.
Exactly.
And if we look at the stock market as a whole, as measured by the S&P 500, it's down on any given day. 46% of the days are negative, and 54% roughly are positive days in the market.
Mm-hmm.
So
On
you're
average.
going to see a negative day.
Yeah,
it's
you're
just fact of life.
Well, you are going to see a negative day, and I think that's part of it. See, here's the thing. If all you saw were, if the stock market never went down, there'd be no risk, and everybody would jump in to the stock market and keep buying and buying, which, of course, creates risk because the whole thing's going to collapse. So,
Well, we saw this back in the late 90s, from 95 to 99. The attitude and the interpretation, maybe, of risk changed because the market was up 20, 30% every year. There were almost no down days. It was just up, and up big every day. And so people then got complacent, got lulled into this idea that, well, the broad market goes up every day. So I just need to hang out with the broad market until I find that one individual stock that I can make double overnight, basically, is what it was the attitude of people.
yeah.
And so they got the idea that the stock market as a whole was no longer volatile to the negative side. Well, they got a little bit of an eye awakening, in 2000, early 2000.
Well, and that's what happens. I mean, it created its own risk, and the same thing.
It created complicity, and people thought, well, it can never go down. Yes, it can.
It
and
can.
It will.
Well, we saw it not only that, but we saw the same complacency with the housing market in 2004, 05, 06, 07, right in there, when everybody thought housing prices would go up and up. So, I mean, it's just, there's nothing you can do about it. It's its own cyclical, by nature. Stocks are cyclical, up, down. As you said, 56 or so % of the time, they're going to be positive. 45 or so % of the time, 44, it's going to be negative. But given enough time, and I think that's the key, Professor Plum, as we've said many times on this show, time is the key, right?
Definitely. Time dictates how much risk you want to accept. If you want to take it and put your money in the stock market and the money you need is to spend next year, be my guest, do it. But you are accepting risk.
Yeah.
You are accepting the fact that you could lose money.
Yeah. You might not.
It's like somebody goes to Vegas and says, well, I'll never lose. Are you on drugs? It just
But the
doesn't
thing
happen.
is, you might, the problem is sometimes you do win. You just get lucky, The risk never happened. It's like driving
And
without a
some people
seatbelt.
are luckier than others.
Well, that's what
Some
happens.
people
Yeah.
don't have to deal with Murphy's Law.
Well, you know what?
Unfortunately,
Luck,
I do.
luck does play a role in this as well. Well, I wanted to just follow up on that because we have had over the last few months from people who had listened to that show that we did, earlier this year, and I wanted to address that. Excuse me, because again, it's an important distinction to make, and that's why, Professor Plum, I would suggest that we like the bucket strategy. Would you agree with that?
That's why we created the bucket strategy. I mean, this is the whole deal.
Yeah. Buy time.
We had a client that's in 1994 that said, I just sold my business. I don't want to have to worry about my cash flow ever again. How do I make this happen? And he didn't want to see negative or numbers that affected his cash flow. So we created the strategy.
Yeah.
We've honed it over time, but it's been fairly true for the 30 years.
Well, as we said before, measure a strategy by how many calamities it's had to survive, and we've had quite a few, big and small, over the last 30 plus years. We've seen that. So, Professor Plum, hey, by the way, if you want to know more about the bucket strategy, you can go to luciacap.com, LUCIACAP.com. We've got all kinds of things up there. If you're new to it, take a look at it and learn about it. You can also learn, of course, more about on this podcast, which you can subscribe to. I don't think I mentioned this last week, but I'm going to mention it again. Spotify or Apple Podcasts. Make sure you download every single episode. Don't miss one. We are coming up. I just checked again, Professor Plum. We are coming up on episode 200. I don't know what
You
happens
were
when we.
big about that 10 episodes ago.
I know that,
and then
but
you
we're-
haven't mentioned it for the last 2.
I think we're like 4 or 5, 6 episodes away. I've got to check. So nothing's going to happen at episode 200. It's just a nice little psychological barrier for us. Hey, we made it 200 episodes. But you can certainly listen to all the past episodes, subscribe, download, and listen to them on a regular basis. This podcast. You want to talk more with Professor Plum or any Lucia Capital Group advisors? Talk about your bucket strategy. Do you have a bucket strategy? Are you interested in learning about the bucket strategy? Give them a call, 800-644-1150, 800-644-1150. Talk to the folks at Lucia Capital Group. They'll be happy to help you out. As Professor Plum just said, we've been doing this for 30-plus years. And I think, Professor Plum, the advisors have learned a thing or three about volatility, risk, and how to help potentially mitigate that.
Oh, yes. I mean, the idea that when the markets crater, we're not getting calls from panicky people saying, sell, 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 turn those machines back on and sell. We don't get those calls.
Yeah, it is. We've had some ugly times, but
yes.
but no panic. Professor Plum, I thank you so much once again doing our little remote broadcast. We've got 2 in a row, and it's worked fairly well.
That's going okay.
Yeah, not bad, not bad. I appreciate you being here. For Professor Rick Plum, Certified Financial Planner Professional, I'm your podcast host, Johnny Dean. Thanks so much for listening. It is Managing Your Financial Future. We will, of course, talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. These materials are provided for general information and educational purposes based on publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. Past performance is no guarantee of future results. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies and leading industries. An investment may not be made directly in an index. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. A value averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities, you must consider your willingness to continue purchasing during periods of high or low price levels. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial, inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. Before investing, carefully consider an exchange-traded fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC.